Another approach to growth investing is the use of growth screens. In this learning objective, we look at the evidence regarding the efficacy of those particular screens. So it's important to note when it comes to growth screening is not simply just using the inverse of value screens. In fact, when passively screening for growth, what most growth screeners tend to do is to look at growth at a reasonable price. So this idea of growth at a reasonable price means looking for stocks that possess characteristics whereby you'll believe that those particular firms have strong growth prospects, yet it's likely that the growth has been currently underpriced by the market. There are two main growth screens that tend to be used across the industry, and these are the PEG ratio, which is the price earnings to growth ratio, and earnings momentum or earnings growth across time. So starting with the PEG ratio first of all. An investment strategy using PEG ratios is one where you screen stocks based on the ratio of their PE ratio to expected growth. Now if we think about the PEG ratio, what that is the PE ratio on the numerator. That we know is a measure of the value of the firm or whether a particular stock is cheap or not. On the denominator, we then have a measure of the growth of the firm or the expected growth of the firm. So where we have a low PEG ratio, it means we've got a stock with high growth prospects yet low price. So that is a stock that has growth at a reasonable price. This implies that passive growth screeners will buy stocks with low PEG ratios. Now, there is some evidence that suggests that stocks that have a low PEG ratio do tend to earn higher returns. A Morgan Stanley study found that this was the case, that stocks with low PEG ratios outperform the S&P 500 index. However, it's been argued that this outperformance can simply be explained by risk, because not only are low PEG ratio stocks earning higher returns, but they also tend to be riskier. So if we have a look at this, what we can see here is that evidence of returns of stocks with low versus high PEG ratios, and this is broken up into three subsample periods: 91 to 96, 97 to 2001, and 2002 to 2010. And across all sample periods, there's basically a downward trend. That is, the average annual returns of stocks with low PEG ratios tends to be higher than the average annual returns of stocks with high PEG ratios. So this is used as a justification for why these growth screeners would use this PEG ratio in their investment strategy. As discussed before though, it's highly argued that this PEG ratio effect can be explained by risk. And one way to demonstrate that is to look at the relative PEG ratios of stocks sorted into deciles based on their risk. So we've got the riskiest stocks through to the safest stocks. And we find that very risky stocks tend to also have very low PEG ratios, whereas the safest or least risky stocks have high PEG ratios. So one possibility is this result we saw before, the higher returns generated by stocks with low PEG ratios, is simply just a compensation for the higher risk of these stocks. Hence, they should earn a higher expected return, and that's what we're observing. Another strategy based on passive screening for growth is earnings momentum. So this is the idea of looking at earnings growth over past periods. If investors underestimate the growth prospects of firms, or they don't fully incorporate it into prices, then stocks that have experienced positive earnings growth over the past should achieve positive returns in the future because that earnings growth is not fully embedded into the current price. A study by Cordia and Shivakuma looked at splitting stocks into portfolios based on their change in earnings from the most recent earnings announcement, and they actually report evidence that high earnings growth stocks outperform low earnings growth stocks by about 0.9% per month. So this is consistent with this idea that using growth in past earnings can be a way that you can identify those stocks with growth prospects, and this appears to have some merit as an investment strategy based on the philosophy that investors are not fully incorporating those growth prospects into the price. So here's the evidence reported here looking at the subsequent returns of stocks using portfolios formed using past earnings growth. So we can see those stocks with low past earnings growth, the lowest past earnings growth, they on average over the sample period earn a return of about 0.8% per month. Our portfolio returns are almost monotonically increasing, whereas those stocks with high past earnings growth earn subsequent returns of about 1.7% per month. So quite a substantial difference across those two portfolios. So last thing to consider, given these two different growth screens that we've discussed, important to identify what might be some of the determinants for success with growth screening. Well, first of all, it's important that investors have superior judgments on growth prospects. They must have the ability to identify screens that are going to be effective in order to identify those stocks that do have growth at a reasonable price. This is again an investment strategy where you need a long-term horizon. Like any screen, these are long-term systematic strategies, so it's not something that should be used by a short-term investor. Arguably as well, a investor using growth screens might need market timing skills. There's going to be extended cycles where these growth screens work exceptionally well, and these cycles tend to be related to broader market movements. So an investor who can time various cycles in the market and time periods where growth screens work well can use this as part of their investment strategy to earn quite significant abnormal returns.